Welcome to Prop 19, the good stuff for homeowners. My name is Jim Cunningham. I'm going to be taking you through a brief walkthrough of all the great stuff that Prop 19 is providing for homeowners, specifically homeowners in California. Again, disclaimer, I'm a lawyer. My lips are moving, words are coming out of my mouth. This is not legal advice. This is information only. Please subscribe to our YouTube channel. That way you're ensured to get the latest and greatest content. It's going to be a big year for estate planning for two reasons. Number one, Biden tax plan. We're expecting the Biden death taxes to increase under the Biden administration and his plan. But even if he doesn't get his tax increase through, it's going to happen in 2026 because that's when the Trump era tax cuts expire. So go ahead, subscribe to our YouTube page. I'm Jim Cunningham. I've been an attorney. I'm a certified specialist in estate planning, trust, and probate law. I've been an attorney for over 25 years. And here's how we help. As a taxpayer, you want to pay the least taxes possible and not a penny more. And this includes property tax. So we're here to help you craft a plan and give you options, make some recommendations that may reduce your overall tax bill, leading to more wealth for yourself, your family, and your loved ones. Now, let's talk about how Prop 19 changes everything for homeowners. And when I mean everything, okay? This is a huge benefit to California homeowners. It frees you up. It permits you to sell your home and take your low Prop 13 taxes to a new home anywhere in the state. So that's kind of the headline on this. But to understand Prop 19 really requires a foundational understanding of Prop 13. And by the way, everyone who buys property in California, everyone is protected by Prop 13 because Prop 13 does two very important things. It caps the amount of the ad valorem. Now, an ad valorem tax comes from Latin, meaning it's from the value, ad valorem. That's capped at 1% under the California Constitution. So your county cannot charge you 3% property tax. They're capped at 1%. Now, you may say, well, Jim, my property tax bill is higher than 1%. Well, there's some other taxes that can be levied. Parcel taxes, those are flat rates typically. Sometimes they're based on the square footage of the lot. Then there are additional ad valorem taxes that are passed by taxpayers. So the base rate is 1%, but you can have these sweeteners in different jurisdictions. And it depends, I'll look at a property tax bill from two different areas in San Francisco, two separate. One's maybe just a little bit over 1% and the other one might be 1.5%. So it just depends on where you are in the city, in the county, and what other subdivision you are. So in the 1970s, let's say somebody buys a home. You buy a home in Cupertino for $50,000 in the 1970s. Well, now it's worth $2 million. The property's assessed at $120,000. Your taxes are $1,500 per year. And that's Prop 13. So what happens is you buy that Cupertino property for $50,000. Your taxes can only go up. So not only is it 1% of the market value, so it's 1% of that 50,000, but those taxes can only go up 2% a year. So 2% a year. So when you buy a $50,000 house, your tax bill is $500. Those taxes can only go up $4 in the following year. Well, what happens is as time goes by, that sort of snowballs and your taxes go up 2% a year. They cannot increase by more than 2% a year. But what's happened to values in Cupertino? Well, they've gone up and up and up, at 4, 5, 6, 7, 8, 9, 10% a year, right? So what happens for people who own real estate for a long period of time in California is many times the market value is significantly higher than the assessed value. Now, what is assessed value? Assessed value is the dollar value that appears on your property tax bill. So for those of you who are homeowners, and it's probably everyone here on or watching this, is you look at your property tax bill and it will say the value of your property is, the assessed value of your property is $120,000 in this case. The market value may be $2 million, right? So in California, many times market value and assessed value are decoupled from each other, right? One doesn't really have to do with the other one. So it can be very confusing for people. Practitioners outside of California, they'll talk to me. They're like, Jim, you guys have the screwiest property tax system. It's great, but it's really kind of weird. So again, 1% of market value, that's your ad valorem or from the value. So if I buy a $2 million property, poof, my taxes go up to $20,000. By the way, the next door neighbor in our example, the Cupertino house, next door neighbor's paying $20,000 a year, right? But you're paying $1,500 or whatever it is. Change in ownership includes sale, pretty obvious. It does include gift, not so obvious. It also includes death. And that's the real sleeper one there, is when a person dies, that is considered a change in ownership. So it's kind of a basic law of nature. When you die, you cannot take it with you. You leave this earth, all the stuff that you own remains. And the state says, that's change in ownership. So you pass away, that's when there's a change in ownership. So what the county will do is they will reassess the property at death. They will reassess the property at death and increase the ad valorem taxes. And that'll be 1% of the fair market value of the property. So the county will value the property. They'll say, even though there was a death and there was no sale, we're going to kind of guess, or we're going to estimate, or we're going to have our own valuation process on what that property's worth and increase the taxes. Again, everyone is protected by Prop 13. Many people say, Jim, I just bought my house 3 years ago. I'm not protected by Prop 13. No, you are, because your taxes are capped at 1%. A lot of other states, the property taxes are 3%. Now the values may be lower, but the property taxes are 3%. And the county can't just willy-nilly raise the taxes. So they're capped at raising it 2% a year. And so we have a couple of questions. Angelina asks, so if a person sells a home with an assessed value of $81,000 and the home sells for $735,000, what would the tax base be that you bring with you? You bring your assessed value. We'll get to that. And same tax base as my parents. We'll talk about that. And then Min asks, the property tax paid is $5,000 a year. I bought the property for $250,000 and it's worth $1 million. After I sell, I would like to purchase a $1.4 million property as a primary residence. How will my new property taxes, what will those look like? We'll cover that, Min. And that's part of what we're going to talk about right now. So the really good stuff in Prop 19. So the question is, would you rather live here in Cupertino, or would you rather live here in Dorado Hills? Now, if you love Cupertino and you love that house and it's your dream house, you're not going to want to move to Dorado Hills. But guess what? If your kids can't afford to live in the Bay Area, and by the way, for those of you in Southern California, this is the Northern California version of this. For those of you who live in Dorado Hills, is kind of like the Westlake Village of Northern California, if the Bay Area is LA. So for those of you who say, you know what, my kids have moved to the western slope of the Sierras, they've moved to El Dorado County, and I got 3 grandkids, they're living there, and I really kind of want to see my grandkids, and I want to, it might be nice to live in this nice big house. Many people want to make that move. So what we see is a lot of people moving from the Bay Area up to the western slope of the Sierras. We see a lot of LA people moving out to the desert, LA people moving to the beach. Maybe they moved to Orange County, San Diego County. Maybe they moved to Santa Barbara. So, this is what happens in your 60s and 70s. It's like, okay, well, maybe we get that final vacation home or move to where we really want to be. And so the law prior to passage of Prop 19 was good, a little stingy, okay, a little stingy, but here's how it worked. You could sell your home in Cupertino with your $120,000 assessed value and $2 million market value, and you could replace it with another home of equal or lesser value in one of 10 counties. Now, El Dorado County is not one of these counties. It used to be. So under the old law, which was Proposition 60 and Proposition 90, okay, and some of you may be familiar with this, you could do it once in your lifetime. You had to be over 55. But you can see it's kind of stingy. It has to be a property of equal or lesser value, and it has to be in one of these 10 counties or moving inside the county. Okay, so you either move inside the county or move to one of these other counties. And the home you're selling, this is really important. The home you're selling must be reassessed. So if you sell your house under the prior Prop 19 rules, right? If you sold your house to your kids and they took a parent to child reassessment exclusion, you can't double dip on that one. So, it has to be the same market value. If you wait a couple of years, it goes up, 105, 110% of the market value, not a whole lot of help. And you have to file your claim, right? You have to file the form with the county. So this is the law prior to Prop 19. So let's look at our example. Let's say you sell your Cupertino property for $2 million. You move to El Dorado Hills. You buy this beautiful home for $1.75 million. Your property taxes jump from $1,500 to $20,000 a year. Why? Well, this is El Dorado County, not Placer County, but El Dorado County is not one of the 10 counties, okay? And neither is Placer, all right? Placer is just north of El Dorado County. So what's going on here? Well, when you sell your house and you buy another one, if there's no reassessment exclusion, you're getting reassessed. Your taxes are going to go up $20,000. They're going to go up to $20,000 a year. And then also the SALT cap, that was the Trump era tax act that was passed, you can only deduct, if you itemize your deductions, you can only deduct up to 10% of state and local taxes. So that $20,000 a year is going to be after-tax money. Now, frankly, a lot of people in retirement do not itemize their deductions, so it may not really matter a whole lot. So you sell your Cupertino house for $2 million. This is after Prop 19, and you buy your El Dorado house for $1.75 million. Guess what? Your property taxes don't go up at all, and that's because of Prop 19. All right. So mom and dad have 200,000 more in their pockets. The neighbor is paying $1,500 a month, your next door neighbor in El Dorado Hills. So you move from Cupertino, you move up to El Dorado Hills, you take your property tax with you. You take your Prop 13 taxes with you. It's very, very, very important to understand. These are highly portable, much more portable than they were back in the day. Well, let's look here before Prop 19. Let's say instead of moving to Cupertino, you're going to make it a little bit. You're moved to Piedmont. Now, Piedmont is surrounded by the city of Oakland. It's a very leafy, beautiful area. Before Prop 19, if you sold your Cupertino house and you moved to Piedmont, which is just south of Berkeley, and you pay $2.3 million, your property taxes are going to jump from $1,500 to $27,000. Okay. Now, Alameda County is one of the 10 counties where you can transfer your tax base under Prop 60 and Prop 90. But unfortunately, in this case, the market value of the property was greater than the Cupertino house. No tax relief at all. There's no apportionment. There's no partial this or partial, can I get 80% of it? There's nothing going on there, right? So Prop 60 and Prop 90, very restrictive, game over, reassessment. Well, what about after Prop 19? Now, Min, this answers your question. What if you buy a house of greater value? Now, this is really super important, guys. You take your $2 million market value and the difference between the two market values of $300,000, that gets added to your assessment. Okay. Let me say this again. If you buy a house of greater value, the difference between the two, the home you're purchasing is of greater value, that just gets added to your property tax bill. So, we have clients who have beachfront homes. They have a $10 million beachfront home in San Diego, and they want to buy a $12 million beachfront home in Santa Barbara. They're going to be able to transfer their tax base. If you have a $1 million condo in San Diego with a $100,000 tax base, you're going to be able to buy a $1 million place in El Dorado Hills and keep your low tax base. Okay. So this is very, very important. You can go anywhere you want. Even if you buy a home of greater value, that difference is added to your tax bill. And this, I just say mom and dad. It's a huge benefit for mom and dad. So we've got a couple of questions here. If a house is in a trust and passes to a son and he chooses to live there as his primary residence, the property taxes don't go up. Correct. They stay at the lower assessed value. Rena, here's the new rule on that. If it is the family home and you transfer that property to your son, sale, gift, death, and your son occupies that residence as the family home, as his residence. So it has to be your residence and his residence. You can exempt up to $1 million in market value over the assessed value. And let me give you an example. If the property is worth 1.5 million, your assessed value is 100,000. 1.1 million goes unreassessed. The difference of 400,000, which is $1.1 million to $1.5 million, that difference of 400,000 gets added to the tax bill. So it depends on the value of the property. Now, for many people, it's not an issue, but for some people it is. Okay. So this is something where this is the purview of lawyers, quite frankly, to figure all this stuff out. And something that you're going to want to do. And we cover this at the very end. You really need to pay attention to your property tax bill. Okay. People don't pay enough attention to their property tax bill. What do I mean by that? There's something called the homeowner's exemption. Now, to have all of this work, you have to have your homeowner's exemption checked. Okay. It has to be your home. What if you don't? Well, this may not fly. Okay. You really need to pay attention to your property tax bill. If you're no longer occupying the home as your home, and if you've rented it out, you need to notify the county and remove that homeowner's exemption from your tax bill and add it to the property that you're actually living in. So sometimes if you'll have a rental, they might move into a rental and move out of their house and rent their house. Pay attention to your tax bill. And that's the homeowner's exemption. That is a $7,000 deduction from the assessed value of the property. You save yourself a whopping $70 a year, 70. But that's not what I'm talking about. What I'm talking about is all this good stuff in Prop 19 to transfer your tax base. It is for your home only. You have to be living there and you have to sell that home. There has to be a change in ownership on your home. And then you've got to, then you buy another home. Okay. It's very important to pay attention to the homeowner's exemption. And we have another question here. Oh yeah. So Rena says the market value is 400,000. The assessed value is 200,000. As long as it stays the family home, no reassessment. That being said, your son has to claim the homeowner's exemption within a year. So again, this is information only, not legal advice, but as a general rule, if it's a $400,000 value and a $200,000 assessment, I wouldn't worry about it. If I sell my house today, original price $250,000, and want to buy another house in California with my daughter and son-in-law, can I still carry my tax base with me, or can I at least prorate it with my kids? Boy, Joan, that's a really good question. I don't know the answer to that question. It depends on how old your kids are. Well, it depends on how old you are. This is for 55 and over. I'm assuming you're over 55. I don't know the question to that. I would assume that if you buy a partial interest in a home and it is your home, that at least that would be apportioned, but I don't know. Angelina asks, isn't the new law after 2021, you could use it now anywhere in California? Yeah, so here's the deal. The Board of Equalization, we've been following this closely. April 1 of 2021 is the date where you can file the paper, okay? So what if you sold a house and your home and then bought another one? Let's say you moved to Dorado Hills and your taxes are $20,000. I think you're going to get relief, but you can't file the form until April 1st. So even if you've already done this transaction, I believe it's either a 2 or 3 year, I think it's 2. The transaction has to be within the 2-year window of April 1, 2021. I'm not sure when they come out with the form, it's going to say, right? Because that's how government forms work. I bought this house, on this date, and it's got to be within that 2-year window. So pay attention to this. April 1st, if you bought and sold a house, a residence, and you're over 55 when you bought or sold it, or make the claim, I'm not sure which. By the way, the legislation hasn't even been passed yet to enact all of this, so we're kind of in the dark. Do the sellers have to be 55 or older for Prop 19 to apply? In this case, yes. So if it's your home, at least I believe one spouse needs to be over 55 if you're married. Kelly Johansson asks, does your new home have to be the same type as the old one? Can I sell a single family residence and buy a farm or vineyard that has a house on it and still keep my old tax base? That's a really interesting question, Kelly. I believe so, but what happens when you look at a tax bill on a vineyard, for example, you'll have land value, you'll have structure, and then you'll have something called agricultural improvements. I don't know the answer to that, but we are going to do a webinar that's coming up that deals with the family farm. And that may be a mashup of those two exemptions. I just don't know, but it depends on the agricultural improvements. I think that would be an issue. Sally asks, for Prop 19, when you buy a new home and sell an old one, does the timing matter as long as it's within 2 years? Could I buy a new home first and sell the old home a month later and still claim Prop 19? I think, Sally, I think so. I think this is all about transferring your property tax base. Now, that's a really interesting question, because what if you have a rental and you sell your home? Can you move your property tax base and cut your tax bill? Probably. I don't know. Again, this legislation hasn't been passed, but this is a really new area of the law. And I will tell you, this is why you need to hire an expert. You can't figure this stuff out on your own. Very few lawyers even understand this. I'm just going to be brutally honest with you. This was a very, very small practice. And frankly, not that many people are trained in it. A lot more people have gotten trained in it recently with Prop 19, but you need to hire an expert. David asks, if the new home costs less than the market value of the old home, how is the tax calculated? You just move your tax base over. So if you have a $2 million home and assessed value of 120, and you buy $1 million home, your assessed value is 120. That's my understanding, which is better than $1 million, right? It's not like it cuts it down in half. That's just too complicated. Suresh says, hi, Jim. What about state and federal taxes when you sell and buy another house? I suppose Prop 19 has no bearing on this, but wanted to confirm. Yeah, Suresh, there are lots of taxes, right? I happen to be right now in the city of Sacramento. I'm also in the state of California. I'm also in the United States of America, right? So those are 3 layers of government. We're just talking about property taxes. We're not talking about capital gains taxes. By the way, if you have a loss carry forward that offsets your gain, You might not pay any tax. I mean, you might not, probably won't. So it just depends. And there are a lot of tax planning strategies that you can do, quite frankly, to reduce that capital gains tax liability. So if you're one of those people who is in the Cupertino house that you paid $50,000 for, and you say, gee, I'd like to sell it, but how do I do that and not get killed on taxes? There are ways to address that. They just have to be consistent with Prop 19. So Pamela says, I'm an accountant. I file many SB, now CDTFA forms. You say after 40121, we can file the paper with SBE. Do you know the form number? No, I don't know off the top of my hand, but it's going to be the form that you file to transfer your tax base. And again, the legislation is pending to implement all of this, and there really wasn't enough time to deal with all of the issues that were brought up. And I will tell you that there is a bill to extend the deadline of Prop 19 to February 15 of 2023. 2023, that's 2 years from now. So there's a bill, it's passed the Senate 34-4. It's SB, as in Sierra Bravo, 668, SB 668. SB 668 is going to alter the definition of a change in ownership. And what it's going to say is changes in ownership between parent and child are not changes in ownership until February 15 of 2023, right? With that $1 million exemption. Now, what is it? I just went through that kind of quickly. What does that mean? That means that there was this mad rush to transfer property from parents to children. This is all the bad stuff in Prop 19. There's a proposal to extend that deadline effectively 2 years. So if you feel like you missed out on the Prop 19 planning, in our firm, we're internally preparing for this to pass, I'll just say. So, and we have a couple of chat questions. Can you talk a bit about how the joint tenant exemption works? Like if I have to go on title with my mom to get financing, I think as long as we're joint tenants, it doesn't count as a change in ownership. Robin, you are correct. Adding a joint tenant is not a change in ownership. Not a change in ownership, okay? Adding a joint tenant, very important. Thank you for raising that. So let's recap the Prop 19 benefits with the Dorado Hills property. The $1,500 tax, $1,500 year taxes stay the same. Full disclosure though, in that particular neighborhood, there are something called Melrose taxes, Melloroos. If you've never heard of Melrose taxes, you are one lucky taxpayer because it is effectively an end run around Prop 13. Melrose are extra taxes that are paid for a specific period of time. They're typically parcel taxes to pay for improvements. So it's an end run around Prop 13. So you're not going to get any break on Melrose. Sorry. With the Piedmont property, the property taxes, this is the benefit of Prop 19. The $1,500 your taxes go up to $5,200. They don't go to $27,000. Okay. So lots of really great stuff in Prop 19 for homeowners. And, you know, it's important as lawyers, one of the things we do as lawyers who are not in litigation, but are helping people plan, is we quantify, we count. And so when I think about saving property taxes, I think if you hold the property 20 years, with the Dorado Hills property, you're going to save $450,000 in taxes. With the Piedmont property, you're going to save $528,000 in taxes. That ties into with what I said at the beginning. You know, our job as lawyers for our clients is to help people pay the least taxes possible, because this means that more money is staying in the family, more money is transferring to your loved ones or the causes that you care about. So it's very, very important to pay attention to taxes. I would say property tax is death by 1,000 cuts. Death tax is death by 1 cut. And please subscribe to our YouTube page. We got the Biden tax increase. It's just around the corner. It's going to happen, folks. If you think it's not going to happen, I kind of think you're kidding yourself. We're internally preparing for a state exemption where you can only leave $3.5 million when you die, tax-free. But they're talking about dropping the gift tax exemption to $1 million. So it means you're going to be constrained. If Prop 19 is extended, for many of you, you're going to want to complete that planning in tax year 2021. Because if you wait until 2022, sure, you can transfer between parent and child, but the structure is necessarily more complex because you're limited to $1 million gift tax exemption. You know, and this is kind of interesting. What we're seeing in the real estate market, I don't know, for those of you who are real estate professionals, there's a lot of activity. I read 100,000 people left. There were 100,000 change of address forms out of San Francisco County between March 2020 and December of 2020. I mean, if that was just one person, that's an eighth of the population leaving San Francisco. What we're seeing is people are leaving the East Bay and moving to the western slope of the Sierra, which is east of Sacramento, and Sacramento, quite frankly, which is east of Sacramento. And then many of the people who are living on the western slope of the Sierra, they're moving out to, other states. Likewise, a lot of people who are living, in some small apartment in Santa Monica, they're moving out to, east or north or south. And then the people who are maybe, living in Pasadena, now they're moving out to the desert. A good friend of mine was living in Orange County. He just got a house in the desert, and he comes in a day or two a week to work, and he's out in the desert most of the time. So what we're seeing is a shift to remote work. This is really changing the real estate market, and you're seeing a lot of people move. You're seeing a lot of houses trade. Prices are up. Many houses are getting multiple offers. So this will only accelerate that process because the 55 and overs, so to speak, can now move their tax base, which is huge. And if you're lucky enough to have grandkids, hopefully you want to be near them, right? This may be the opportunity, right? Is to move to be closer to family. So, and Case asks, if I sold a California property in May of 2021 and decide to buy in 2024 in another county, can I carry over my older property tax base? No, I think the 3 years, I want to say I'm going off memory. I want to say it's 2 years, but Case, that's something you would want to double check on, but just know there's a time limit. Okay. Now the Board of Equalization has said what it interprets the Prop 19 to be is that there's no time limit other than the 2-year time limit, meaning you could have bought and sold a home in October of 2020 before the election and still make this claim in April of 2021. Okay, so pay attention to this. And this is something, if you're a real estate professional or you're in real estate, you may want to go through, your closed transactions and let your clients know, hey, you know what, there may be a benefit. They'd be really happy to have their property tax bill cut. Who wouldn't? It's a no-brainer. So, Prop 19 requirements, over 55. Now, there's another one, severely disabled. Okay. A victim of a wildfire or natural disaster. So we're not quite sure what the victim of a natural disaster means. If it's a declared area, we're not quite sure what that means. Not more than 3 times. Now, what if you're married? Can one spouse do it, and then the next one, the other spouse do it? Maybe, but look, moving 3 times after you're 55. I don't know. I don't know that many people are going to move 3 times once they're over 55. So now, is it 3 times plus the other one if you did the Prop 60 or Prop 90 transfer? Yeah, maybe the Board of Equalization says, well, we don't really know. Yeah, okay, maybe so. Maybe it's 4. If the properties of a greater market value, these are kind of big takeaways and requirements. If the properties of greater market value, remember the difference is added to the tax base. You can move anywhere in California, not just within your county or the other 10 counties. Let's see. Best practices. Here's what you're going to do. If you want to know about this stuff, you need to find an expert. Obviously, our firm does this. Find an expert lawyer who knows the nuances of Prop 13 and Prop 19. It's a very small bar. What I mean by that, it's not like a bar where you go to have a drink. A very small bar means a very small number of lawyers practicing in this area. Very, very small. And I would recommend you approach this with the beginner's mindset. If you have prior knowledge, if you're a real estate professional, if you're a lawyer, you really need to kind of unlearn what you've learned and come in with sort of this blank page in your mind and learn, because it's a lot of changes. Prop 19 brought a ton of changes. Very, very important. Even if you're a homeowner, you need to be able to read your property tax bill. You need to look at it. Okay. Don't go online and get it, because not all the information is contained on there. Okay. It's the bill that's sent to you, the paper bill. Look at it. It's very important. And I would say the number one thing to look at if there's a homework assignment, if you're living in your home and you look at your property tax bill and you don't have that $7,000 homeowners exemption, there is also a disabled veterans exemption of 143 odd thousand, something like that. So if you're a disabled vet, take the disabled veterans exemption. Okay. But if you're not a disabled vet, make sure that that you can read your property tax bill, and you may want to consider making that homeowners exemption if you if you don't have that on your property tax bill. And I'm not telling you to do that. It's not legal advice, but it's something to really be paying attention to. Again, subscribe to our YouTube page and stay abreast of all of the changes that are coming. Prop 19, we're preparing internally. Prop 19 is going to be extended. Okay, that's to February of 2023. We have literally hundreds of people on a waiting list that we were unable to help. If you're one of those who's watching this, our plan is to reach out to you. We just have to figure out an efficient way to do it. So how do you get started? Go to Cunningham Legal. If you would like a consult on Prop 19, okay? Meaning if you're like, wow, I missed the boat, I need to get going on this, go to our website or call us on one of those numbers. That's toll-free number. If you're outside the United States, that's the direct number. That's the non-toll-free number. But make sure you're seeking a Prop 19 consult. Now, here's what I'm telling you. This is not necessarily for, hey, I have a home and I want to sell this home and buy another one. Although, if you want us to go through that and make sure it's correct, I'm happy to do that. This is for the people who missed the deadline of February 15 of 2021. I think Prop 19 is going to be extended. Once Prop 19 gets extended, you're going to have a very hard time to find a lawyer because this is a trifecta. There are three things happening with lawyers right now. Number one, there are not that many estate planning lawyers who know this stuff. That is a fact. Again, a very small bar, right? 7% of lawyers even practice estate planning, and a very small percentage of those can handle the advanced planning that you're going to have to do with the Biden tax hike. So number one, there aren't enough lawyers. Shocker, right? But this year, there won't be enough lawyers. Secondly, you've got the Biden tax hike. Now, what I mean by that is the exemptions dropping, income taxes are going up. It's going to happen, all right? And many people are doing advanced planning, and we're already getting them in to our office because I'm telling people, you need to pick your advisor, your savvy advisor now. Do not wait for this, folks. It was a disaster with Prop 19. Every lawyer I knew was just working crazy hours to help their clients, and there's going to be a mad rush. So if you're waiting until like October or November to do some planning for this Biden tax hike, I think it's going to be too late, okay? And the other thing is lawyers cannot scale, right? This is very specialized knowledge, and somebody who really knows what they're doing has to be working on it, and there's only so many hours in the day. The third thing that's happening, so we've got not a lot of lawyers, the Biden tax plan, if Prop 19 gets extended, which I think it will, many people will need to do the planning this year because the gift tax exemption this year is $11.7 million. The gift tax, meaning I can give 11.7 million tax-free. My wife can give 11.7 million tax-free. That's a lot of money, right? That's getting dropped to $1 million per person. So many of our clients have legacy properties. They might have an apartment building in LA that's worth $3 million. And they say, you know, I'd really like to preserve the Prop 13 taxes. I'd like to give this property to my kids. That's going to be a taxable gift, right? If you're single, it could be $800,000 in gift taxes. So you have to structure it differently. So if you give it to them, big tax bill. If you wait till next year, right, you keep your low Prop 13 taxes, but that's kind of a big price to pay, right? 40% on amounts over $1 million. So you're going to want to think about this well in advance of the end of the year and get your A team together. You remember the TV show, The A Team? I mean, like the one from the 80s or the 70s, right? Not there, I guess there was a remake. Get your A team together. And this is your lawyer, your financial advisor, your CPA, maybe an M&A lawyer if you're selling a business, whatever it is, your real estate professionals, get all those people together to help you preserve this wealth for your family. So we've got some other questions here. I will answer those questions in the chat. Bravo, thank you for another excellent webinar. Oh, thanks, Lola. We have Rena asks, if the son in my previous example chooses to keep it as his primary residence after his mother's death, but after a year or so decides he cannot maintain the home and it's 5 acres and wants to sell it, can he do, can he without property tax consequences? Well, Rena, if he's 55 or over, he can take that property and transport, port his Prop 13 taxes to a new property. But if he's under 55, if he sells it and buys another home, it's going to get reassessed. Okay. David asks, has the governor indicated that he supports? I am so glad you asked this question. David, has the governor indicated that he supports Senate Bill 668? He doesn't have to. It just has to pass each house by 2/3 of a vote. This is called urgency legislation. Urgency legislation. Passes the Senate 2/3, passes the Assembly 2/3. The governor, doesn't matter if he doesn't like it. It's law, okay? On the extension of Prop 19, is that just the parent-child part, or does it extend the 55 aspects? It's just the parent-child part. And thank you for asking that question, Russell. All the good stuff in Prop 19 basically became effective the day the ballot initiative passed, in my mind. Okay, all the good stuff. It's just that you have to wait until April 1 to file the form. Okay, and you file that with your county assessor. I moved out of California years ago, still have an investment property there, which I hope to sell in the coming months. Prop 19 is no bearing for me, right? You know, if you're going to sell, if it's an investment property, the good stuff in Prop 19, this is only about your residence. If you're going to sell property in California, it's very important. California wants their taxes. Now, you can do a tax deferred exchange, a 1031 exchange. You will have to file a form with the state that says, yeah, we made some money. And the rule is, if you ever sell that property and there's a gain, you may be probably owing California tax money. I mean, I don't know how all that works. If you're living in Kentucky and you sell a property in Kentucky, yes, you're legally required to notify California. And as a lawyer, I would say, yes, you have to follow the law. I don't know that people actually do that in the real world. If I decide to work with your company developing a living trust, will you be able to tell me if a Prop 19 consult is needed during the first living trust consult? Yeah, I mean, and let me tell you something. This is a really good question. We have a few clarifying questions. Number one, do you have children? Because if you don't have children, Prop 19, passing your Prop 13, it's going away anyway. Secondly, do you plan on selling this property during your lifetime? If you plan on selling it during your lifetime, there's no need to save Prop 13. The third question is, if you have kids and you're not going to sell it during your lifetime, are your kids going to hold on to this as a long-term hold? And if the answer is yes, it makes sense to preserve the property for Prop 13. If the answer is no, you know, the whole point of preserving Prop 13 is this long-term play, okay? It's this holding property for not only your life, but your children's lives, or a very long period of time. And that's why I put 20 years in there. But, you know, if you're holding it for a year after you pass away, I'm not sure. I mean, it might be worth it. I'm not sure it's really worth it. Just depends. So Pamela asks, I have no children, but want to leave my property to my nephew and have him occupy it. Can he get my low tax base? As Prop 19 is written, unless there is a parent-to-child relationship, the answer is no. Now, I just said something very legalistic, unless there is a parent-to-child relationship. It's an extremely broad category in California, but if it's your nephew, probably not, probably out of luck. Okay, Rena asks, I'm over 55, but what if your son doesn't want to transfer to another, your son's over 55, but he doesn't want to transfer to another home because of all the costs to maintain. If he sells it and lives with my daughter, no retroactive property tax from lower assessed property tax benefit he enjoyed from the time of his mother's death to the time of sale. No, he does. It's retroactive, maybe, but I think you might have to own the property April 1st would be my guess. When you file the form, it's typically a homeowner filing that form. I'm not sure I totally understand your question, but hopefully I answered it. If there are any other questions, it's going to bring us to the end of our time here today. For those of you who have watched this whole thing, thank you for watching. Prop 19 is a tremendous benefit for California homeowners, and a lot of people are really going to be saving a lot of property taxes, quite frankly. Min asks, old and new property both located in the same county, Alameda. So when I buy a new one and I sell my $1 million home and buy a 1.4 million, what do I need to inform the realtor to fill out the form correct to the same county? I'm not sure I would rely on the realtor as much as you might just want to reach out to the assessor and explain to them what you're doing. I sold this property and I bought that property, and here's my old tax bill and here's the new sales price. What forms do I fill out? Okay, so just tell them what happened. Counties, remember this, assessors are publicly elected officials, right? We live in a democracy. They're responsive to the people. They're actually very helpful. Okay, don't be afraid to reach out to the assessor. And many times those people, hopefully the person you get is very trained, but I mean, it's their job to assess property and deal with this stuff. So they're typically very good and very professional, and certainly willing to help you. I can't, Rena asks, I can't find the answer to my question anywhere on the web, and that's why I joined your webinar. So I'm sorry about that. But looking on the web, it's kind of tough. And I would say that Prop 19, there's very little on Prop 19, and for two reasons. Number one, it's recent, but secondly, the rules haven't been written. So we're not even at April 1st of 2021 at the time of this webinar. So so we're still waiting for the forms. We're still waiting for the laws to come out. What forms will I need to file with the tax assessor to save my tax base? Well, the forms you would look at is the homeowner's exemption, and sometimes that's available online. I think El Dorado County, you actually have to call them and leave a message, and they send it to you. And that's one of them. But if you want to transfer your tax base, there's a form that the assessor will have once this is law, and once April 1st has passed. Hopefully shortly thereafter, though, each county will have its own form, and then you would complete the form. And so you would be completing the form in the county that you're moving to. So if you're in the same county, it's the same county. But if you're moving from Alameda to El Dorado County, you would be going to the El Dorado County assessor saying, hey, I sold my house in Alameda in 2020, and I'm buying my place in El Dorado Hills in 2021. Here's everything that happened. I went to this webinar. I heard I can save my taxes. Hey, is this going to fly? You really need to pay attention to the homeowner's exemption, because it's really helpful if that's on your tax bill. So Rena asks a follow-up question. Basically, if the son changes his mind in a few years after inheriting the home, what happens? Well, Rena, that's a great question. You die, your son inherits the home. The assessed value is $200,000. The market value is $400,000. Your son keeps the assessment, provided that you've checked off the homeowner's exemption, right? You filled out that form and it appears on your tax bill. He's got a year to move in and claim the homeowner's exemption. Okay. So assuming that he does that, the property taxes stay low. If your son says, hey, I'm going to go to Hawaii for 3 years and rent this property out, he's got to uncheck the homeowner's exemption, right? He's got to take that off. The taxes go up to $400,000, the 1% of $400,000, whatever the market value is. And then he's going to pay higher taxes. And then after 3 years, he moves back and his taxes go down. That is my understanding of how the family home exception works. So by changing his mind a few years later, if that means he's not living there, then the taxes very well may go up. Now, what if he doesn't tell anyone and just leaves a homeowner's exemption on there and he's collecting rent? I don't think the assessor's driving around to see who's renting and who's not, but arguably it's tax fraud. Okay. I mean, actually it is tax fraud. So you need to follow the rules. And I'm an officer of the court as a lawyer. I'm going to tell you, you need to follow the rules, even if you don't like the advice, right? So Russell says, if a mom who had a revocable trust died in January of 2021, ooh, good question. So Russell asks, mom has a living trust and dies January of 2021 and leaves her home to her 3 sons. Should the successor trustee hold off in filing the affidavit of death of trustee until after Senate Bill 668 passes? Russell, we have another webinar on our YouTube page. It talks about how to buy out a sibling. So the fork in the road. I would have 3 questions if I were helping you guys out. Number 1, are you going to sell the property? Right. If mom passed away and your plan is to sell the property, it doesn't matter. Okay. Now, there's a form you're going to want to file, which is a claim for reassessment exclusion between parent and child. If you're going to sell the property, you can file this form, claim for reassessment. First, you have to file you have to notify the assessor of the death, and then you file a claim for reassessment exclusion between parent and child. So the 3 sons, because your mom died in January, there's no reassessment. Okay. I'm assuming the property goes from your mom to you. If you're going to hold on to the property, if the 3 sons are going to hold on to the property, you're not going to get reassessed. Okay. Now, if one son wants to buy out the other 2, if you do it the wrong way, 2/3 of the property will get reassessed. If you do it the right way, the property will not get reassessed. That's the subject of a video we have on our YouTube page. We did a webinar on how to buy out a sibling. I would suggest you look at that webinar. Certainly reach out to us if you need some help. If you're already represented, then I would talk to your existing lawyer. Does Prop 19 override Prop 60 and 90? What are the differences? or Prop 68 and 69. Prop 60 and 90 is what I was talking about. Does it override them? I don't know. It kind of coexists with them. I mean, the assessor doesn't know what to do with this. The Board of Equalization, they're like, well, do we get 3 plus the 1 from the prior law? So that's a little bit of a kind of an up in the air. So Charles asks, my home is in a trust. If both my wife and I pass, the house remains in the trust and one of the children moves into the home, does the tax base change? Well, as long as it's your home and a child moves in. So if you have 3 kids and they all 3 co-own, this is improbable. The 3 kids, no one buys anyone out, right? And the 3 kids on the property, and one, the first child moves into the property. Yeah, as long as the property is not worth $1 million more than its assessed value. Remember that example I gave? It's assessed at 100,000, but it's worth $1.5 million. You're going to have a partial reassessment. But if it's assessed at 100,000 and it's valued at $1 million with Prop 19, no change in your taxes, provided the children remain, at least one child stays in the family home. This is a new concept for California law, the family home. If that child moves out, you're going to get reassessed, right? If it's no longer the child's residence and they maybe rent it out or something, certainly if you sell it, it's going to get reassessed. So it depends on what the numbers are. It also depends on if you have claimed the homeowner's exemption and when your child moves in, if your child claims a homeowner's exemption. If you're already enjoying Prop 90 from a move to El Dorado County to El Dorado County from Alameda, great. I think it's probably going to be neutral. It wouldn't be any help. Prop 19 is not helping you. Can you expand on the disabled veterans exemption? Yeah. So if you're a disabled vet, then you have a much larger homeowners exemption. And I'm going off memory. I think it's 143,000 and change. But that's if I think it's if you're 100% disabled, and it's going to be typically service-connected disability. By the way, if you're if you're former military and you're disabled, check and see. There are varying degrees of disability, but I believe you have to be 100% disabled to get it. And I don't think it's scaled. But again, I'm not an expert in that particular veterans benefit side. So Rena, if your son changes his mind and sells, then the property is going to get reassessed, the person who buys it, and he loses his Prop 13 benefit unless he's over 55 and takes it to a new home. Son is living in the second home but has joint tenancy. Do the taxes remain low? So that's anonymous. That's a good question. If you add a son as a joint tenant and then you die, the property is reassessed. The transfer occurs on the death of the original owner. So if I own a property and I put my son on as a joint tenant and then I die, the change in ownership occurs when I die. So if I add him in 2021 and I die in 2031, there's no change in ownership in 2021. There's a change in ownership in 2031. Whether the property is reassessed or not depends. Is it the family home or the family farm? If it's not, it's going to get reassessed. If I sell the El Dorado County property and purchase another property, will I be able to transfer the Alameda assessed value to this purchase? I believe so. The question is, can you use your Prop 60, Prop 90 that you used a few years ago? Can you use the Prop 19 exemption after April 1st? I don't see why not. I would check, right, with the county that you're going to and make sure that that's okay. So, and if you say, gee, I don't even know the questions to ask, this is, you could hire a lawyer to do it. You could hire our firm to do it and ask and root around and get the right answer before you make the move. It's very important. Son is living in second home of mom, titled as joint tenancy. Do the taxes remain low? Again, it depends on how it was acquired. So do the taxes remain low? If mom owns the home and puts the son on as a joint tenant, the taxes remain low until mom dies and the full property is reassessed. Couldn't the son claim the co-tenancy exclusion? The co-tenancy exclusion is for original owners, and you can transfer property as joint tenants and then subsequently, so the logic goes, transfer it as tenants in common. Or the other way around, but that's a little more complex. And with Prop 19, at least for now, being effective and not extended, that is, it's creating a lot of questions, for a lot of practitioners. So that's a little bit more complicated question without more facts. And let's see. My child is 18. When is the right time to add the child's name under Prop 19? I'm still lost. What needs to be done with Prop 19? Please help to answer. Min, it's probably best to talk with the lawyer, whether it's us or another attorney. I'm really not a fan of putting in a young person's name on the title, because once you do that, you've frankly given the property to that child, and they can, they have creditors, they can get a divorce, they can, your relationship can sour, they can marry somebody you don't like. I mean, there's a whole, parade of potential horribles that can happen. I think that's something that a decision you should make after some legal counseling, not just, me just saying whatever, So the question is, should I add an adult child to my title? That's a big question. Okay. I'm a fan of keeping control. And if you just name a child, if you put something into somebody's name, you're losing control. And it's not that I'm a control freak, but bad stuff can happen that really might not even be your son's fault. So that brings us to the end of our time together. Thank you for joining us today. And please subscribe to our YouTube page and stay informed, and have a great, great day.